Hello guys, welcome to Back to Basics episode 16, where I'm taking my lovely fiancée Jessica and teaching her how to trade. So this is the 16th episode, so if you're just tuning in now, there's a playlist on both of the channels that you can kind of check out. It's right here. If you're seeing this on my channel, know that Jessica's has one episode in advance, so you get a sneak preview over there, and just give us follows. So we have gone over, I said there would be a test, but then I forgot that there was a couple patterns. So after this, there'll be a test. We may have to split it into two parts. It's going to be a long test. So have fun with that. All of the patterns. So you remember all the ones we went over so far? Roughly?
Ish.
Yeah. All of those were continuation patterns, right? You know what that makes sense? They were looking for a stock to go up, take some sort of a break, and then continue in that direction.
Okay.
Right? And that's continuation patterns or trend following patterns, or more or less what they're called. These they call reversal patterns because they're not meant to get something that's going and then have it pause and then continue. They're have it going and stopping and reversing. So you can use these in a trend if you, say, wanted the stock to be going up and then come down and then kind of pick the bottom before it continues higher. These patterns signify that the stock is about to, at least in the short term, change whatever direction it's currently going.
Okay.
Okay, so that's why they're called reversal patterns. So there's the double top, double bottom, head and shoulders, rounded bottom, rounded top, and cup and handle. So these are the ones that I said you'll probably laugh at all the names of because they're all silly names, but you'll see why they make sense. Double top. Can you guess what a double top would be? It is probably exactly like you're thinking of.
Or it goes up and then it goes down and then it goes back up again?
Close. It is a double top, right? So if this is a stock price, so a double bottom is it comes down, it makes a low, and then it bounces. Mm-hmm. And then it comes down to around the same price and it bounces off again.
Okay.
That's a double top. It means that there's somebody that was there on the top. There's someone that was there that was selling at that price, and he sold enough that the stock got scared and came back. And then when it came back to test that point again, he was still there. And then it sells back again. So that one's pretty simple. So here on the neckline is simply just where that last pullback stopped before it continued higher, right? So it pulled back the first time and then popped back up. So generally how someone will trade this, they'll sell on the break of this neckline and their stop will just be over the top.
Okay.
That makes sense? There's more examples here. So this is kind of an actual chart, what an actual chart would look like.
Okay.
So the stock's moving up and then say gets to $100. Say that's $100. And then someone's selling a whole bunch at $100. So as we talked about before with the psychology, if people see these topping tails on the candles and they see a bunch of selling going on around $100, they'll just join in. They'll say, well, I'll sell at $100, and if it gets over $100, I'm wrong. And then you get this reversal down where buyers gave it one more shot, said, okay, we're going to hit it again. And then we hit it again and it's selling again. And the theory behind that is there's some sort of a hedge fund or some sort of large institution that maybe has owned this stock for 50 years and now they're trying to sell it. They've got a whole bunch to sell and that's their area that they're trying to sell it in. Right? So then the short would be the second time when it breaks through this neckline, it means that the buyers that were there to hold it up before failed. So you can see how it's like a channel that didn't last very long.
Okay, that's what I was just about to say. So how are you picking this up then? That's what I don't understand. Is if where's the trade here?
Two ways to do it. One is when you see it kind of starting to move down, which is very subjective, but you could say when it pulls back off of that second top by X amount, you would short that. So
until the neckline.
Somewhere in this area. And then maybe you cover at the neckline or maybe you see if it continues on first. The pure play, like if you picked up a textbook and read it, it would say you short when the neckline breaks because that's saying that whoever bought it here before
is gone. To
make that bounce, he's gone. Okay. He doesn't have as much power. And then you would put your top up here. And the theory being that basically the market got scared. It pushed up and it just hit this brick wall and fell down. It pushed up the second time, it hit the brick wall again. They go, okay, I don't know how big that wall is, but I'm not going to try it anymore. So you think about it, if you were long this stock, so say you were an owner of this company and you saw it come and hit $100 and pull back, and then it came out and hit $100 again and it pulled back, you may start to get nervous and say, I don't think this thing's ever going to get over $100. Let me get out.
Right.
And that's what causes this pattern. So next, the head and shoulders. And all of these have an up and a down. You can flip it, right?
Okay.
So a double top can be a double bottom, and a head and shoulders can be an inverse head and shoulders.
Okay.
And the reason this is called a head and shoulders, and I probably should have reversed this, but just think of it, just flip it in your mind, whereas it's got, right, one shoulder, and then it spikes up higher, and then it's got another shoulder. And this is a reversal pattern that you could almost see is two triangles, right? If you drew a line from here to here, it would make one triangle. If you draw the line from here to here, it would make another triangle. But essentially it just means, again, I always want to equate these back to they're not magic patterns. They're psychological phenomena. Stock selling goes down to $10 and then it bounces. And then it sells down a little further, it goes to $7 and then it bounces again. And then as you would think about it, if this was a trend, this next trough should be lower than the head, but it's higher. And this is showing that essentially what's happening is that the buyers became more aggressive here. So every time that there was a peak and a trough before, it went lower and lower. But this time, the buyers stepped in before the lows and then pushed it up.
Right.
So it's just showing that there's a potential that buyers are getting more aggressive as the stock is pushing lower.
Okay.
So the trade here is generally you take the break of the neckline, which a double top, the neckline is the lowest point to the pullback. In this one, you can see it's the lowest point of each pullback. They call that the neck.
Okay.
And you would take a break of that neckline, which is just a trend line through there. And here is saying the stop goes above the head, but usually people will put it above the shoulder. Because if this breaks down, then it's now a downtrend again. But you can see that this one's interesting because from a pure trend point of view, if you imagine your trend trading, a downtrend is lower highs and lower lows. This is basically saying, okay, the stock has had lower highs and lower lows, but now it has a higher low. It's the first time it's established a higher low in this trend. Therefore, maybe buyers are starting to get interested and push it up. So here is it on an actual chart, right? Okay. And this is, again, flipped because any of these can be flipped around. But the stock moves higher, and you can see that this is an uptrend, and it's an uptrend until this right shoulder forms. Mm-hmm. And then it says, okay, so basically...
So where's the trade here? So after the right shoulder?
After the right shoulder breaks down the neckline.
Okay.
Again, conventional wisdom says stop above the head. I'm more stop above the right shoulder.
Okay.
And then you take the distance between the head and the neckline, and that's your target.
Okay.
And again, this leads to just kind of a rant, I guess, that I'll have about these patterns, where the benefit of these patterns and everything we talked about says we're trying to get you right like 51% of the time. Right. But you can see how the benefit to these patterns isn't so much their accuracy, it's the fact that you know where you're wrong. There's no guessing. Mm-hmm. You know roughly where you should be shooting for a target. And we'll talk about how I don't use targets in a later episode, but I want you to start with targets. But you can see how that whole risk management plan is in these patterns. So you're not just, because the reason that most traders fail is they shoot from the hip. They go in, they say, I think this company sucks because I went to their store and there was no one there and it's a shitty company. And they'll just take a short and they don't know where they're wrong. They don't know where they're right. They don't know any of these other parts of the trade. So you can say, I'm going to short this because I see a head and shoulders. And even if it's not a head and shoulders, you know where you're wrong. You know where you're right. Mm-hmm. I mean, it just helps in that way. Now, these are my favorite. This is...
This, like, I liked the look of that head and shoulders thing. I thought that was like not an easy read, I shouldn't say, but like from a beginner's standpoint, it was easy for me to see on the chart. That head and shoulders.
Then that's great. What we'll do is we'll have a scan for you in Trade Ideas that will find roughly this pattern. Okay. And you can start going through them. You could trade this pattern. And remember, even though these are reversal patterns, it could be a trend continuation, because zoom out on the chart a little bit further here and say that this had started way up here. and then it had come down to here, and then it did this pattern. Well, then you're still trading with the trend,
Right.
even though it's, again, it's, you tapped on this really early, that a trend is just relative. If you zoom into this area, it's in a downtrend, right? If you zoom into this area, it's in an uptrend. So just because these things are reversal patterns, you could be a pullback trader. And a pullback trader is what I always wanted to be, but never had the discipline to be.
Discipline's not my forte.
Not your forte, but it's a great way to go, because you're on the side of everyone else, but you're not chasing the move like everyone else. Everybody wants to be what they call a breakout trader, and the reason they do that is because the rewards are instantaneous and the pain is low. But the problem is the probability of success there is also really low. So a breakout trader basically says, think of your channel. When it breaks out of the channel, I'm going to buy it. And then if I'm right, those moves are explosive. But the problem is stocks do a lot of break out of the channel by a little bit and then come back in. And then break out of the channel by a little bit and come back in. So it becomes harder. Whereas if you're more of a pullback trader, you're the one looking for it to break out of the channel, come back and test the top of the channel, and then go. So it takes more patience,
Right.
but you're just waiting for more. And then what happens is every now and then it breaks out of the channel and just goes. And you have to be okay with saying, I just missed that one because it wasn't my style.
Right.
I'll wait for the next one. It's Warren Buffett's got a quote basically saying that the difference between trading and something like gambling or sports is that this quote was with baseball, is that you can walk up to the plate, put the bat on your back, and wait for 1,000 pitches to go by. Right? Because you don't have to swing. You only have to swing when you see what it is. So if you go through and you scan, I give you a list of...
Poor analogy.
You
only have 5 pitches.
Right, but what he's saying is that in trading, you have as many pitches as you want. The market is always open. There's stocks always moving. If you don't see a pitch that to you is perfect, you don't have to do anything.
Right.
And nothing bad happens to you. You just don't make money. When we get to a point, this is why I always talk about how traders should have some sort of separate income stream and blah, blah, because you want to be that person who, scans through a list of 20 stocks and maybe you don't find anything. You just don't do anything the next day, right? It's very hard, especially when it's something that you're making money off of, to do nothing. When you have, this is why it's great, and I think we'll focus on this one pattern for you. We'll show you the other ones. There's 2 more. First, it means that you know what you're looking for and you just look for that one thing. If it's not there, you don't do anything. Right. So again, these are my favorites, and the rounded and the cup and handle are going to be really close to each other. But this is just kind of it. You have a stock that either, it doesn't matter if it's pushing down or up from this, and you have this nice rounded slow bottom, and then when it breaks out of what they call the lip here, and I have examples from the real world, is where you purchase. And it basically just means that it's kind of like a slowing of momentum slowly, and then the market slowly starts to grab momentum and come back up again, and it's more of this slow gradual pattern. But again, right where you're correct, and it is a breakout style trade, so it is one of those that the rewards are immediate and the pain is low. Most people would put their stop at the bottom here. I would put my stop above whatever the most recent kind of congestion is. Again, a little bit harder to see.
Yeah, that is harder to see.
Right, but
me personally.
But you pick a point that's kind of the left side of where it came into the round, and then you watch it as it makes a rounded bottom, and then you get a breakout out of it. And just like with most things, the target is the width from here to here. The benefits of this pattern is you could see if you bought this breakout on this green candle right here, you could have put your stop right below that candle and only had a super tiny little risk for a very large profit. And that's why I like them. I'm okay with having a really low win rate. I'm okay with only being right 55% of the time.
As long as those are, yes.
As long as those take off. Some people are not. Some people, they'll lose like 5 trades in a row and they'll lose their mind.
Okay.
Right? And they'll go crazy and they'll be trading super big and they'll double down to get that money back. I've just been doing it so long that I don't care. I just know that if I stick to these low probability but high risk reward scenarios, that eventually I'll make money. But it took me, well, you were there first for some of it. It took me years to get there, right? But that's it. So now the cup and handle is a little bit more defined of a rounded bottom. You can see that it actually looks like a cup with a handle on it, which is why it gets the name. But it has this rounded bottom, and then what's this pattern for you for your test? Just that little bit.
A little bit of a channel, isn't it?
Right, but what's a short channel?
Flag.
Right.
Okay.
So it's like a rounded bottom with a bull flag on the side.
Okay.
And I really like these ones. And again, here's an example of that. You have the stock moving up. You have this big cup right here. And then when it gets to the point, because you got to think about it, this area where it reversed before is going to be resistance again to some respect, right? That's usually how the markets work. So when you get this small pullback after it's hit this resistance area before, then you buy the breakout of this line and your stop can go right here. So you don't need to put your stop way down in the bottom here. You can just put your stop a little bit far away and you get these big explosive moves up. So the way I look at it is that these cups are just a way, it's like it gathers energy almost through there, right? Because as the sellers are pushing it down more and more each day, they're being able to push it down less and less. It's taking more force to push it less. And then on the other side, the sellers are failing. So as we break in this new high here, the sellers have kind of given up.
So what's the significance of the handle? Like what is...
It's a place to place a tight stop, and that's mostly it. But again, so if I were to cut off this half of the chart here, that just looks like a bull flag.
Okay, yes.
Right? So we know bull flags, and I talked a little bit about the stats behind the patterns, but we know bull flags have pretty good statistics on them. And then these rounded bottoms, we know have pretty good statistics on them. So it's a combination of like two patterns, which is something that you'll do a lot of because, say you were trading a head and shoulders, but the example that we gave, it just broke right through. But what if it came down to the neckline and then you zoom in and inside the neckline you see a bear flag?
I don't know.
Well, it's stacking a pattern on a pattern. So instead of
I wasn't aware there was like double stacking of patterns.
And then there's multiple time frames. So maybe on the weekly chart where each one of these bars is a full week, maybe it's formed a head and shoulders. And then maybe you zoom down to the daily chart and you see a different pattern. And then you zoom down to a 30-minute chart and you see a different pattern. So then instead of having to use the weekly chart for your stop loss, now you can use the daily chart for a stop loss. So what you've done is it's all about reducing the risk in a logical way. So instead of risking $10 to make $20, that's good. That's still a good trade. That's a 2-to-1. But if you can zoom in more and you find something that's logical, like a logical pattern, and now you're risking $2 to make $20, well, that's a 10-to-1, right? And so now you've gone from having to be right over 50% of the time to only have to be right 20% of the time, right? And anytime I say that, you only have to be right 20% of the time, it means if you're right 40% of the time, you're making a crap ton of money. Everything is fractal, right? Which means that a pattern that exists in a long time frame will exist on a smaller time frame, will exist on a smaller, to the point where we have in Trade Ideas a scan for day traders that looks at a head and shoulders. So they may be looking at this on like a 1-minute chart, right? And each of these is a minute, and they're trying to short it here and cover 5 minutes later. Again, it's just different time frames of the same. And that's why we always say it has to do with psychology, because it's the only reason that these things could exist on this kind of fractal nature. That's it. The cup and handle makes sense. Again, I scan for round bottoms. I build a list of them. I wait for these kind of congestion type patterns, the triangles, the pennants, the flags occur, and then I take the trade knowing that I have this whole kind of stored energy behind me. And that's a little bit of my trading style. Which, speaking of, what we're going to be doing on the next episode is probably just 10-15 minutes of me going through charts and drawing in these patterns just to give you some real world examples. And it's going to be just random. I'm going to set a clock for 10 minutes and we're just going to go through a big old list of charts. And every time I see something, I'm just going to draw it in and get your opinion on. And then next week, test. You ready?
Not yet.
Not yet? Okay. Well, again, I hope you guys like this. This was a little bit of a longer one, but some good information, I think, there for sure. All right, guys. Well, that is it, and I'll talk to you next time.